Thank you, Belinda. Good afternoon, everyone, and welcome. Extremely excited to have you all here and have you join us, of course, for this very special event, which we're calling State of the Economy. And, of course, it's featuring Federal Reserve Bank of Dallas President and CEO Rob Kaplan. We are so looking forward to an informative and thoughtful conversation with President Kaplan. As you all know, the economy is king, and we want to know what the economy is going to look like and what we can expect and how we might be able to plan using the helpful information that Rob will provide. As we begin, though, I'd like to take a moment to, of course, thank our event sponsors. Our title sponsor for today is CPS Energy, and our patron sponsor today is SWBC. As you all know, the support of companies like CPS Energy and SWBC make it possible for the Chamber to continue to do our work, which is focused on a prosperous future for all of San Antonio. I also want to take a moment to thank my Chamber team for their dedication throughout this pandemic. You all have flexed and adapted in ways that have kept us focused, and we're serving our members and our community while juggling all the other things that we all have, from schooling our kids from home to caring for loved ones and just being safe. Team, your commitment to learning new technologies and rolling with the punches have kept us meaningfully connected to the business community and to the education, nonprofit, and governmental communities of San Antonio. So thank you. And I know that I'm not alone in saying we appreciate your efforts. I also want to take a quick moment to thank our more than 1,850 different business members. Your continued support in the face of the economic downturn spurred by COVID has allowed us to keep our businesses engaged and informed as we work through this public health crisis and plan for beyond. And now I'm happy to introduce Paula Williams, President and CEO of CPS Energy, our title sponsor of today's event. And Paula also happens to be the immediate past chair of the San Antonio Chamber of Commerce. She's going to share a few words and introduce our featured speaker, Rob Kaplan. Paula leads a more than 3,100-member team with the vision she has coined that's called People First, whereby CPS Energy is evolving its efforts to create and deliver value to its customers, community, and employees in this new age of energy solutions. Paula has more than 30 years of leadership experience in San Antonio and received numerous national and global recognitions for her innovation and commitment to customers and the community. She is a proud graduate of San Antonio College, holds a BBA from St. Mary's University, and an MBA from Regis University in Denver. Ladies and gentlemen, please welcome my dear friend, Paula Williams. Paula, the floor is yours.
Richard, thank you so much. I am excited to be able to do this introduction today. Many of you know me, and I typically do not like to be scripted. However, when there's a bio and when there's a bio that for an impressive person that I really respect, I want to make sure that I get it right. So I'm going to read this to make sure that I don't mess up. So, Robert Steven Kaplan has served as the 13th President and CEO of the Federal Reserve Bank of Dallas since 2015. He represents the 11th Federal Reserve District on the Federal Open Market Committee, and his area of coverage that he oversees includes Texas, Louisiana, northern Louisiana, and southern New Mexico. On the FOMC, the purpose and focus is on the formation of U.S. policy, and he oversees 1,200 employees for the Dallas Federal Reserve. Kaplan was previously the Martin Marshall Professor of Management Practice and a Senior Associate Dean at Harvard Business School. Prior to joining Harvard in 2006, Rob was Vice Chairman of Goldman Sachs Group, Inc., with global responsibility for the firm's investment banking and investment management divisions. He was born and raised in Prairie Village, Kansas, and Rob received a Bachelor's of Science degree in Business Administration from the University of Kansas and a Master's degree in Business Administration from Harvard Business School. I'm very proud to introduce you to Rob today. I actually have the pleasure of serving on the San Antonio branch of the Dallas Federal Reserve. And with that, I turn it over to our special guest, Rob Kaplan.
Thank you, Paula. Great to be with you. And Richard, thank you. And if I read your background right, Richard, you went to University of Kansas for a master's, yes? Richard's probably off, but I went to University of Kansas, so I'm always glad to meet another Jayhawk.
Go Jayhawks!
Yeah, that got that right. Okay, good. Should I make a few comments, Richard, just to set the table about the economy, and then we'll go to your questions.
Yes, sir. Perfect.
As has been well publicized, in the United States, second quarter GDP contracted by approximately 32% annualized. It's our best judgment right now at the Dallas Fed that third quarter GDP is going to rebound by a little bit more than 30%. So we've had a sharp contraction. We've had a rebound. The rebound might have even been stronger in the third quarter, but for the resurgence in the virus that took hold in mid-June and persisted for a number of weeks. But we're growing, and we're growing out of this deep hole that happened in the second quarter. It's our best judgment that fourth quarter growth is going to be somewhere between 5 and 10%, and that we'll end the year in the United States with an unemployment rate somewhere between 7 and 7.5%, and the U.S. economy will have contracted, when we look back on 2020, by about 2.5%. Okay? If you look out to 2021, our best judgment is that GDP growth is going to be in the neighborhood of 3.5%, so well above trend, and we'll continue to grind down the unemployment rate during 2021. So with that backdrop, let me make a few comments about some of the things that have been unusual and striking about this crisis. And then we'll go, I'm sure, a lot deeper on a number of fronts in the Q&A. First of all, one of the unusual things about this downturn has been consumer income, household income, and consumer spending, in that normally when you have a severe downturn, they would both drop. And you would then get the recessionary effects of drops in income and spending, and businesses would have less business. They, in turn, might need to have fewer people, and you'd get a bit of a downward spiral, what we call recessionary effects. That hasn't happened this time, in that household income and consumer spending have stayed surprisingly strong through this pandemic. We have not gotten a fall off. And in fact, at some points, consumer spending has been stronger than the year-ago period. So why has that happened? Primarily because of the fiscal relief that came early and was sizable. And so that for those who lost their jobs or who couldn't work as many hours, they got fiscal relief and were able to continue to spend, make ends meet, and that is a big part of the reason, when you look at the United States versus other countries, why our GDP contraction has not been greater than it's been. If you look at other countries, they've had much more severe contraction. They may actually have better statistics, many of them, in managing the virus, so they have a strong rebound, but they're still going to have a contraction greater than the United States because they haven't had the size of fiscal and, to some extent, monetary response that we've had. Okay, so that's point number one. And this is why you've heard people like me and others say that if we don't get some extension of fiscal relief, you might actually see household income and consumer spending get weaker, and you may get a different type of recovery than the one that I just described in the base case. Second thing that's unusual about what's happened in this pandemic is how it's disproportionately affected different groups. I don't need to tell you, if you're a small business or a business in a person-to-person contact industry, this has been a very difficult period because consumer engagement has dropped dramatically, and we measure that through a number of pieces of high-frequency data that we follow, and we've got a mobility and engagement index that we've constructed. And particularly, consumers have been far less engaged than they were a year ago, earlier in the year, and it's affecting small business and person-to-person contact industries. The thing that's happened, though, is while you may not be flying as much or you're not going to restaurants as much and there hasn't been as much spending on entertainment and going to movie theaters, that GDP hasn't necessarily gone away. It's shifted to other sectors, and you've seen it. Home improvement spending has gone up dramatically. Home prices have been stronger than people might have expected, and people are working much more remotely than they have before, and so the GDP is shifting between sectors, and that's why some people call this a K-shaped recovery. There's been a good recovery in certain sectors and not a good recovery and much continued difficulty in other sectors. The other reason people use the K-shaped recovery to describe this is the way it's disproportionately affected different groups in the population. And what I mean by that is if you've got a college education, it is far more likely that you're able to work remotely. You are less likely in this pandemic, therefore, to lose your job, and you're more likely to see your income stay relatively stronger. If, on the other hand, you've got a high school education or less, it is far more likely that you're working in a service sector job that involves person-to-person contact, and it's a lot more likely that you can't find a way to work remotely. You don't have a choice but to either go into work, or you don't have a choice because your job has been lost, and you're far more likely to have lost your job or to have fewer hours than you need to make ends meet, and you've seen your income decline. And we see this in the statistics by educational attainment, and I would note it's particularly indicated by the unemployment rates for blacks and to some great extent Hispanic population in this state and in the country. And again, you see it in the unemployment statistics for those with a high school education or lower. The problem with this is we're going to have a lot of work to get those groups back into the workforce, and that while we're rebounding, a lot of the jobs in the service sector, person-to-person service sector, are not coming back. So a lot of the people that have lost their jobs may not have a job to go back to because the business they worked at may not survive, or that business that they would have gone back to has fewer jobs and plans to keep fewer jobs. And so those people may need to be more likely to be retrained in order to get back in the workforce. And we'll talk about this in the Q&A, but it means coming out of this pandemic, investments in beefing up skills training, investments improving early childhood literacy, investments improving secondary education, I think were critical going into the pandemic, but they're even more critical now in order to invest in the adaptability of our human capital, particularly those with a high school education or less, so that they can be more adaptable to get back into the workforce. And it's going to be critical that we make progress on that in order to improve GDP growth as we come out of the pandemic. So I guess those are key points I would make, and I'll probably stop there, turn it over to Richard to ask whatever questions that you'd like to ask.
All right. Rob, thank you for that. And we'll get into some of those opportunities. You know, we'll have some local elections here. In addition to the national elections, we have local ballot initiatives that we'll talk about that I think hit right to the heart of what you're talking about, to be able to invest in early childhood education, quality early childhood education, as well as retraining. But before we get there, thank you, by the way, for that great overview. And I want to remind everybody to, of course, submit your Q&As, your questions in the Q&A box. We want to get to as many questions as we can. So, Rob, let's start at the very beginning. Let's level set here. You know, you have an amazing group of folks that work for you, and you work for a larger group of the Federal Reserve, but not a lot of people necessarily know what the Federal Reserve does, right? I mean, it's kind of a mystery unless you kind of follow the stuff like us and sort of geeky. But why don't you start at the beginning and tell us, well, what is the structure of the Federal Reserve? what do you all do, and what's the relationship of what you do to Congress and the president?
Okay. So there's 12 Federal Reserve banks in the United States. I run the 11th district, but there are 12 districts. And so there are 12 Federal Reserve presidents, and when we're fully staffed, there are typically 7 governors. Okay? We meet formally every 6 weeks in D.C., these days remotely, but in D.C., and that group of the presidents and the governors that meet every 6 weeks, that's referred to as the Federal Open Market Committee. And when we do meet in D.C., we usually have a 2-day meeting. Normally we have committee meetings Monday. We have formally start the FOMC on Tuesday. We break for dinner Tuesday night. We continue the meeting Wednesday. And normally you see that by 2 o'clock Eastern time on that Wednesday, we announce our decision. And we normally then the chairman has a press conference. Okay, and that the public is familiar with. In any individual reserve bank, our composition, I mentioned we have 1,200 people. We have a big supervision staff in every reserve bank, so we oversee all the banks in our district. Number one. Number two, we have a big research department. I have 30 PhD economists just here in the Dallas Fed that work on economic research about the region and on the country and the world. And that helps inform all of my thinking about what's appropriate monetary policy. We oversee payments at the Fed in the United States. So if you send a wire or electronic transfer, the Fed is an operator in both those businesses, and we have a big population of people. It used to be if you wrote a check, that was processed through the Fed. And then we have a big community outreach effort in that we are very active in our communities as a catalyst doing research. And in this district, we've got a team of experts that work on early childhood literacy, the digital divide, skills training, and a lot of the other pressing issues, access to financial services, a lot of the pressing issues that affect our district. The composition of every district is a little different, but it gives you a sense. And so a lot of the things that I work on and my team works on, a lot of them are in the district and a lot of them are nationwide. So, for example, I chair all technology for the Federal Reserve System, okay? And that's not, I chaired all budgeting for the last few years for the Federal Reserve System. So we work as a team, and a lot of our people, work some in the district and they work in the nation. And with the crisis, last comment, with the crisis, I spent a lot more of my time working outside the district during this crisis than inside, because I'm part of a whole range of teams to work on the municipal market and other markets, PPP, Main Street, you name it, as part of what we've had to do to respond on this pandemic. So let me stop there. That's a brief overview.
Good. That's excellent. That's excellent. This is what I wanted to get folks to understand, that you all are a sophisticated organization. You've got a lot of smart people that are working there and focused on one thing, and that's how do we do this thing right and get as much information so y'all can then push that information out and up. So thank you for that. So let me go to our first question from the audience. So it's from our friend Javier Lopez de Ovesco. He happens to be, Rob, the president of the San Antonio branch of the Asociación de Empresarios Mexicanos, which is a group of Mexican business people that live in the U.S., and there's branches all over the U.S. His question is, how will Mexico be affected by this newest state of the economy, and specifically also Texas? Are we going to benefit or not from what's going on?
So Mexico has had a very challenging incidence of the virus, as many people in your audience may know, and they have not had the capacity for fiscal policy like the U.S. has had. So the best estimate from the Bank of Mexico is that GDP in Mexico this year will contract by about 8.8%. So I mentioned the U.S. is about a 2.5% contraction, which is very challenging. Mexico's is 8.8% contraction, okay? Now, Mexico believes, and the estimates from the central bank are that they're going to grow something like 5.5% next year. But this has been a very, very challenging time in Mexico. And again, a lot more of their population works in the service sector. They haven't had the ability to have fiscal policy the way we've had here in the United States. And so, and the living conditions are different in that, there's more congestion in cities, and also where families live together, where if one young person gets it, I don't need to tell you, there's much greater risk of spread. So it's a more challenging time. I think the good news is USMCA got resolved, NAFTA got updated, and it resolved a lot of that uncertainty, because I think over the horizon, I still believe, as I did going in, our integrated supply chains and logistical and trading relations with Mexico are going to be critical to the competitiveness of the United States. They're very important to Texas, but they're very important to the entire country. And so the last comment is, if Mexico is having this kind of economic challenges, you can be sure that it affects Texas, and certainly at a minimum along the border, and that we're used to people going back and forth across the border and shopping and all those things. And so I'm sure we're seeing these challenges reflected in economic conditions along the border.
Very good. Thank you for that. Another question from someone that sent in says, with the airlines and energy taking a big hit, and we're expecting a 3% growth, where will the growth come from?
You mean next year?
Yes.
So eventually, we're going to rebound. Certain things are going to change and are not going to snap back. People working remotely a little bit more. Maybe people on the margin are going to travel less. People are going to investment in technology is going to be more important. Disruption is going to be more important, and we're not going back on that. Having said that, people are going to stay in hotels again. They're going to travel again. They're going to go on airplanes again. People are going to be in office buildings again. Maybe be a little different than it was, and people will still shop, but there probably won't be as much need for the amount of retail space that we have in the United States. So you're going to have a restructuring. And so there are going to be plenty of places for growth. And what I would guess you're going to see is a lot of the depressed industries that are depressed right now, they're going to come back. But what's it going to depend on? It's probably going to even be more than a vaccine. It's going to depend on a vaccine, widespread distribution. My guess is we're going to be socially distancing and wearing masks for all of 2021, because it's going to take a while, and we're going to have to see how effective the vaccine is. But when we get out to 2022, 2023, a lot of the depressed industries you're seeing today are going to have some rebound, and that may even include energy, by the way, which has been very depressed. Now, alternatives and other structural changes are going to have an effect, but even that on the supply-demand balance, you're going to see that improve. And so the hard part is judging the timing of getting from here to there, and that's hard to predict.
Definitely the $1 million question. Several $1 million questions. Very good. So here's another question. So like many cities across the country, the digital divide in San Antonio has become more consequential with the shifting of so many activities to online platforms that, of course, require high-speed broadband. What are your thoughts on the tie between closing the digital divide and the economic recovery, in particular for small and medium-sized businesses?
So there's the public sector aspect of this, in that when I look at charts of sort of quote unquote brown areas. Brown means they don't have Wi-Fi. In Texas and in the United States, you see there's a number of cities in Texas that just don't have good access to Wi-Fi. So it's affecting more than businesses. It's affecting children and schools and their ability to learn. And God, I don't need to tell you right now, if you don't have access to Wi-Fi in your home, and you need to learn remotely and do other things remotely, it's a big challenge. So there's a public infrastructure aspect of this that may not necessarily, the money may not need to come from the federal government, but I think it will need to come from a consortium of local nonprofits, local businesses, working with the mayor and other officials to make sure we've got Wi-Fi in a lot of these areas because it can be critical to this issue of early childhood literacy and improving educational attainment. And then it's going to vary by industry in that lots of small businesses and businesses generally I talk to all throughout this state and in the country tell me that today, you know, it was a nice to have if you had a big technology investment. What's an example? If you were a fast food restaurant, it was a nice thing to have. It was a nice thing to offer your customers. Today, it's mandatory because people like to pre-order and they want to be able to get the food on a contactless basis, or they want to do delivery, and you've got to have the technology investment. And so there's a different story for every single industry, the technology story, but it's hard to find, including higher education, by the way, where, you know, industries that heretofore you thought, they're immune to this, or they're going to be slow. This has jump-started the need to do that across the board, and you can't get around it. But what does it mean? It means if you're a small business, it's expensive to invest in technology, and you may need more scale, and it's creating a lot of challenges, and I'm seeing it. And it's also limiting your pricing power, which is having a big impact depending on what industry. And if you're competing with someone who can add customers digitally for not a lot of incremental cost, they can limit prices, and you don't have pricing power. And so this is creating a whole range of challenges. And while this has been going on for a while, this is going to continue to accelerate. We're still in the early innings of this, I would guess.
Very good. Thank you for that. So here's a question about Texas. Texas has reaped the benefits from a robust oil and gas market for several years. Of course, that's not what's happening now. What is your outlook on the energy industry and oil markets in general? And how will that impact our Texas economy, particularly going into the legislative session in January?
So I guess the good news is, given there's been such a challenging time, the energy business, by our estimate, at this stage is about 8.5% of the state's GDP, plus or minus. That surprise some people, in that if you go back 10 years ago, it was a much higher percentage. But the story of Texas has been immigration of people and firms to the state over many years and diversification. You know, we've got much more growth in technology and a whole range of industries. And when I talk to businesses here, and including a number of the CEOs on my board, it's not unusual to talk to them about the fact their business wasn't in Texas 10 years ago, and they've come from other parts of the country. And so that's helping the state be much more resilient, okay? Now, having said that, I don't need to tell people this is a very challenging time for the energy business. And there's been job losses, restructurings, bankruptcies, et cetera. It's our own judgment at the Dallas Fed. We have a very significant energy group, and we do a very significant and widespread survey. We think U.S. production is going to decline from 12.8 million barrels a day to start this year to about 10.8 million barrels a day to end the year. It's a significant decline. And that assumes that most of the shut-ins have been reversed. So we're going to have a very substantial decline this year, and it's our best judgment that production will be about flattish next year. But that's saying a lot because the decline curve is so significant, you're going to need a lot of new drilling for U.S. production to stay flat next year. We think it will not be sooner than the end of 2021 before all this excess inventory gets worked off. And so, but we think it will get worked off, and you're going to get in better global supply-demand balance. So the industry has a number of challenges, but fossil fuels are going to be a big part of the energy needs in the United States and the world for decades to come. And this will be a very important industry, but it goes without saying, it's got a lot of challenges that it's trying to manage through.
Excellent. Sounds right on target, and of course we're in for some rough sledding, but things are going to eventually get better, and I think that's the good news about the whole thing. So let's talk a little bit about you all at the Federal Reserve, and we'll focus back on you all. And by the way, you've got an excellent staff here. Blake Hastings does a great job, and his staff is very, very helpful. So congratulations to you on that.
Yeah, thank you. They are great.
So let's talk about the fact that you all have taken, of course, unprecedented action in response to the crisis. You got some interesting programs, important programs, and one of those, of course, is the Main Street Lending Program. Can you talk to us a little bit about the program and what specifically is the Fed using those programs to address? And is it working?
Yeah, so let's talk about all the Fed programs with Main Street being a part. So we've got, as part of the CARES Act, we worked with Treasury to create a whole range of programs to deal with public markets and then to deal with lending, okay? And on the public market side, we stepped up and provided offers to either issuers or to backstop these various markets. That includes money markets, corporate bond market, municipal bond market, and other markets. And what I've seen is there hasn't been substantial take-up, but that doesn't mean these programs didn't serve their purpose. They did. So the muni market, which I'm involved in almost every day, is an example of that. It's a $500 billion program. There's been very little issuance to the Fed, but we provide a pricing grid that is at rates that are higher than the current market. By providing that pricing, the muni market rallied substantially because it gave confidence to private investors that there's a backstop to this market. And so I think it's a sign of success that there's been substantial issuance in the muni market and the corporate bond market and others with private capital away from the Fed. So I don't think take-up is a good indicator of how successful the programs would be. I think they've been extremely successful and are working well. The two lending programs are, one was the PPP, where that was a loan program which included forgiveness, tremendous demand. Banks throughout this district have done yeoman's work with their clients, customers, to try to execute that program. Some issues, logistical issues, maybe some challenges on forgiveness, and we're working through it, but it's been a successful program. The Main Street program has been challenging, and I think from the get-go we knew it would be challenging. Here's why. If you're a good credit and you wanted to get a bank loan, you didn't need to wait for the Main Street program. You went to your bank and you got a loan, and the bank was glad to make you a loan. So a substantial number of businesses in the country did that. If you were a weaker credit, you'd struggle to get a bank loan, but the problem is the Main Street program has credit requirements, okay, and coverages of EBITD and other credit statistics where if you're an unduly weak credit, you don't qualify, and also the bank has to hold 5% of the loan, and one of the criteria is the bank has to want to make the loan and hold 5% of the loan. So what bankers are telling me is they're still doing lending, but if they have a good customer, they don't want to use Main Street because they want all of the loan, or they want a lot more than 5%, and they don't need the Main Street program, okay? And so the dilemma is if there were going to be more take-up to that program, you'd need to ease the credit requirements and other requirements and maybe the refinancing requirements. And that's not really a decision by the Fed. That's got to be a decision by the Treasury. As I've often said, we're lenders, not spenders. If you ease the credit requirements, we're going to have more loan losses, which I think might be a good thing to do, but it's not the Fed's decision to do that. But it's not like mid-sized and small businesses aren't getting loans from their banks. They're just, for a variety of reasons, they're not using Main Street, and it's probably not surprising. And I think there could be improvements made to Main Street, and we've talked about it publicly, but it's really the decision of the Treasury and Congress.
Very good. Thank you. So, Rob, we've got a couple of questions about debt, government debt. So just this week, the San Antonio Express News, our local news, ran an article earlier in the week about Chairman Powell's view on this very issue. In summary, his thoughts were that at this critical moment in time, the need for additional fiscal stimulus is more important for recovery than being concerned about rising debt. You talked about debt in your opening comments. What are your thoughts on debt and more stimulus?
Okay, so going into before the pandemic, and if for those of you in this audience who read my essays and heard me talk, probably there's not a speech I give where I don't mention that I thought the path of U.S. government debt was likely unsustainable. This is pre-pandemic, and that debt held by the public was about 77% of GDP, and the present value of unfunded entitlements was in the neighborhood of $65 trillion. Then the pandemic happened. And my own view is, from a monetary and fiscal policy point of view, we need to do what we can to mitigate the negative effects of this pandemic. This is a crisis, and I think we'll be well served through the monetary actions we've taken and fiscal actions, because what you want is you don't want a permanent scarring from this downturn. The flip side of this is there's a cost. And that debt held by the public, I said 77% before, it's now approaching 100%. Present value of unfunded entitlements is continuing to trend up, not because of the crisis. And so this is why I've said all year, the number one economic policy tool we have, besides fiscal and monetary policy, is wearing a mask. And that I would much rather we widely wear masks. Epidemiologists have been advising me since March. If we all wore masks, we would mute the transmission of this disease. Consumers would be more likely to be re-engaged in the economy, including getting on airplanes, and it will cost us less money from a fiscal point of view. And so the part that's challenging is we've done good things on managing the pandemic, but it hasn't gone as well as other countries. And we've spent more than other countries on fiscal policy, and we've gotten benefits from it, but maybe not as much as we might have gotten for all this money spent. And we're now having to spend more because of the path of the virus, fears of resurgence, and we've still got an elevated level of unemployment. Once we get through the pandemic, it's a long-winded way of saying once we get through the pandemic, I am sure we'll have to go back to, as a country, and this is away from monetary policy, looking at how to grow faster. That will help mitigate debt growth, and all the other aspects of debt growth that are going to be relevant. The only reason why this is not a crisis, and we're very fortunate, is that the dollar is the world's reserve currency, and people around the world in times of crisis want to overweight to dollars. I think that's going to go on for some extended period of time. That's not imminently about to change, but I think we'd be well served not to count on that to go on indefinitely. And so after we get through this crisis, God willing, I think we're going to need to focus on, again, doing things to mitigate debt growth and not rely so heavily on the fact that the world needs to overweight to dollars.
Excellent. Very good. Thank you. There's another question. So how will the Fed respond if there's no fiscal stimulus, in Q4, and job markets turn down further with permanent job losses? What are your thoughts?
So obviously, I hope that doesn't happen, and my best judgment is I think it's less likely that'll happen. But if that were to happen, and we just never did get fiscal extension, to me it would put more onus, even more onus on what I just said: mask wearing and really elevated discipline and widespread discipline on following the health protocols. And that's vital right now. It'll even be more vital because we really can't afford to have a resurgence if we can all avoid it. And so it's going to put even a greater premium on that. The Fed has more it can do, but I've said this, the Fed can ease financial conditions, and it can do things related to that. We can't replace lost income, though. Okay, that's uniquely suited to fiscal policy. So the only ways to mitigate income loss are tamp down the virus. That'll help because consumers will be freer to reengage and spend more, and there'll be more jobs, lower unemployment, hopefully, than we would have otherwise. But fiscal policy is unique, and monetary policy can't really, we don't have a tool that can easily replace that. And that's why continued some form of fiscal relief, while we have elevated unemployment, we expect to for some time, is going to be important.
Very good. Here's another question. In your opinion, have you all thought about expanding the Federal Reserve's mandate to include a focus on equity and inclusion within the economy?
So I will just tell you how I've been working the last few years, and I think I'm not unusual in the Federal Reserve System. So when I look at unemployment and whether we're at full employment, our thinking and my thinking has changed on that. When I first got in this job in the fall of 2015, you know, in talking to my staff, we would have thought the unemployment rate, the full employment rate, which we're at full employment in the country, I think we were using a number maybe 4.5%, 4.75%. So what did we learn? What did I learn? I learned that because of technology-enabled disruption, inflation is more muted, and it gives us a little bit more latitude at the Fed to drive down the unemployment rate lower. And what I also learned is while at 4.75%, that's a historically low unemployment rate, you still have elevated unemployment among blacks, Hispanics, those with lower levels of educational attainment. And so underrepresented groups still are not really fully participating, and there's a gap between the whole population and those groups. What I learned was by driving down the unemployment rate lower, we drew those groups in, and the gap started to narrow. And I learned firsthand that's a very healthy thing, because if you can get an underrepresented person back in the labor force after they've been out for a while, and they get job skills and they get trained, and they're in the labor force, they tend to stay. And they might stay for 20 years. That's a great thing for the country, because GDP growth is made up of growth in the workforce and growth in productivity. And we're aging as a society. We need more people in the workforce. So I've been factoring in a more inclusive labor force for a number of years in judging whether or not we're full employment. So I don't see that changing. And I've learned that I need to go deeper than I did before in looking at underrepresented groups and create a more inclusive labor force. And I've learned, and I believe that's going to create a stronger labor force and a stronger economy for the United States.
Excellent. Thank you. Here's another question. So with such a public view on global connections due to the spread of the virus, do you see any impacts to the view of global trade by consumers?
Well, so let me make sure I think I get the gist of the question. So we're less than 5% of the world's population. And so trade is very important in the United States. And it's very important to our countries. We're fortunate. We've got many of the best companies in the world. If they can compete globally on a level playing field, they're going to do well. And that's going to mean more jobs here. The other thing I would say on that is I think it's wise to segment our trading relationships, starting North America. The relationship with Mexico and Canada are very valuable, based on our research at the Dallas Fed, very valuable to the United States in that they allow us to have integrated supply chains and logistical relationships. There's a reason that Ford or big auto companies call their plants here assembly plants, not manufacturing plants. It's because they use these logistics and supply chain arrangements, and goods go back and forth across the border regularly, which allow U.S. companies to domicile here, add jobs here, and make sure we're globally competitive. We've got more jobs here than we would otherwise if it weren't for those trading relationships, and a high percentage of imports from Mexico are U.S. content, okay? The trade relationship with China, on the other hand, is mainly a final goods relationship, not an intermediate good relationship. okay? We still have some logistics and supply chain arrangements and but not as much. And so we'd need to handle that differently. And so I was concerned, and I said this publicly over the last several years, it's one thing, the dispute with China, I think, is going to go on for years and is understandable and appropriate, plus intellectual property and technology transfer. But it was critical to get settled down, these trade relationships in North America, because we can take share. If we've got those, we can take share from Asia. And so back to the consumer, all this means prices are likely lower here than they would be otherwise. That, along with technology, has made it more attractive for the consumer in the U.S. To have a bundle of goods and have limited pricing pressures, and trade's very critical to that, as well as creating jobs.
Excellent, excellent. I'm going to touch on, you talked about workforce development, training, pre-K, or that sort of thing. So on our local ballot in November here, we have an 1/8 of a cent sales tax that we want to use for 4 years of training, job trainings, to upskill people. The folks that you talked about whose jobs probably won't come back because of the contraction in the economy, the way things are going to change. That will allow them to do short-term training certificates all the way up to even a 4-year degree. So that's on the ballot. That's a 4-year opportunity there. And then we also have on the ballot to use an 1/8 of a cent sales tax. So that's an 1/8 of a cent, another 1/8 of a cent to re-up a program that we've had for the last 8 years called Pre-K for SA, which is a high-quality pre-K program to get young people ready for school. And it even includes actually an extended day program, which we've just done a survey that extended day has allowed families who keep their kids in the extended part to be able to stay working. By the way, most of those folks that are using the program are essential workers, so they've been working, and so this gives them the opportunity to work a little bit more, and it's kicking in probably somewhere in the area of $250 a week in earning power for them. So tell me about your thoughts on these two opportunities here in San Antonio.
So it won't surprise you. On the one hand, I'll stay away from all the political aspects of this, and that I shouldn't be endorsing levies or I'll stay far, far away from that. I can say this, though, based on our research, and I've said this many times, and I'm a business person, so I'll speak as a business person. The highest return on equity investment we can make is in improving early childhood literacy and beefing up skills training. Why? Back to what I said before. GDP growth is made up of growth in the workforce and growth in productivity. And I've been alarmed by the percentage of kids in this state that are starting first grade reading behind grade level. Because the research shows if you start first grade behind grade level, you never catch up. What does that mean? You're less likely to be employed. You're less likely to be productive. You're not as adaptable. It just means lower GDP. Skills training is more immediate. You don't need to wait. Early childhood literacy is a multi-year investment. Skills training means you can get people back into the workforce now in highly productive jobs, and it all is good for the economy. So if you really wanted to grow the economy, these are two investments that are high return on equity investments, and as a business person, I'd want to prioritize them.
Wonderful. Thank you. And of course, I didn't mean to put you on the spot, but I think you hit exactly where I wanted, which was these are ways that are true and, the best ways to use money, right? I mean, we need to hit it and we need to put it, particularly when you have very limited resources like we do.
And we should use that term more. This is not, listen, money for these things are not spending, they're investments. And if I were in a business, I'd call it an investment. And as a business person, I like to make investments in high return on equity projects.
Thank you, Rob. Here's another question. So how concerned are you that small and medium-sized banks may see big loan losses and be obliged to scale back lending as a result of more loans going bad because of the pandemic?
Well, so it's a risk. And, my observation is the banks have been pretty good about reserving against loans on their books that they're concerned about. So they're doing that. And we've also enhanced access to the discount window and other things to allow the banks more flexibility. The issue at this stage in the recovery is the banks have taken their reserves. They've made the loans they've made, or they had loans on their books, and they're being understandably very careful. So I don't think it's going to be an issue. Of course, I'm concerned if delinquencies pick up and if the economy were to turn down again, the banks still may be under reserve, but I think they pretty aggressively reserve. But from here, they're being very careful, and it's understandable because they don't want to take more reserves, and they're very sensitive to the loans they're making. And so that's why it's critical that we get this virus under control as best we can and make progress on it and continue the recovery so that the banks can continue to make loans and the economy can continue to grow. But I would say by and large versus the Great Recession, the banks, because of tough capital requirements, stress testing, the banks are coming through this much better than we experienced in 08 and 09. Having said that, it's a challenging time.
Good, thank you. So, Rob, we're coming close to time. I know we've got a hard stop at 1. So let me close with this final question.
Okay.
From your perspective, what is the most important thing that local, state, and federal governments have to get right in order to not just recover, but to put us on a path for financial stability and positive growth?
So, and I don't want to be, I'm not going to say this in a preachy way because all of us, including me, can do better, but continue to emphasize and encourage people and model behavior of mask wearing and following healthcare protocols. And why? Again, as a financial person, economic person in my job, it's the most potent tool we have. The virus and how it unfolds is still going to be first at the top of the list of drivers of how fast we recover and how well we do. And then the second thing is, I think a lot of the civic leaders I've talked to, private and public, I've talked to about the fact we need to be gearing up now and getting prepared for beefing up skills training and beefing up these early childhood literacy, educational attainment investments, because they were critical before the pandemic. They're much more critical now, and it's going to be more challenging to get people back into the workforce. But we'll have higher GDP, we'll have more tax revenues, we'll all make more money, we'll have higher profits if we can make improvement in this area. So those would probably be the two things I'd mention.
Well, I know you said you're not preaching, but I'll say an amen for that. Good work, Rob. Thank you so much. We are so pleased and so thrilled that you've joined us. Clearly, you understand this stuff. You live it, you breathe it, and it shows. And I can't tell you how proud we are of the fact that you're leading the Dallas Bank and your team here, and really pushing to really do what you can to inform us, inform Congress, and really make the best decisions you can. So congratulations to you. Keep up the excellent work. We will keep our focus on the economy, of course, keep our focus on the things you've talked about, and use that as business people to make good decisions.
Thank you, Richard. Thanks for your leadership. And I will say again, and you said it, we've got one of the great leaders of the Fed in the United States living in San Antonio, and that's Blake Hastings. And he does a lot in the district, but he does a lot nationwide for the Fed, and he's one of the great leaders we have. So we're blessed, and I'm thrilled for you he's living in San Antonio because he does an incredible job.
Excellent. Thanks again, President Kaplan. We appreciate you. And with that, I want to close by another very special thank you to our title sponsor, CPS Energy, our patron sponsor, SWBC. I'd also like to thank all of you who tuned in. Remind you all, please, we've got an upcoming election, hugely important. I will reiterate the fact that we've got a reauthorization of pre-K for SA. We've got a redirecting of 1/8 of a cent sales tax for the Ready to Work San Antonio program, which is a job training. We've also got on there, of course, after this program ends, 4 years later, the Keep San Antonio Moving Transportation Initiative. And even some of us will have the opportunity to vote on the SAISD bond initiative. So please go out there, vote, make your voice heard. And we say, with that, thank you so much. Be safe, be kind, be healthy. And from all of us here at the San Antonio Chamber, have a wonderful week. And we stand adjourned.